All right, guys. So welcome to MAF752. This is the first this is the first finance unit that you do at the master level. So we'll try to go and get you guys on speed as fast as we can. Okay? So we won't be able to go and tell you everything that's happening in finance because it's a very big topic. But we're gonna go and tell you what the fundamental building blocks are, and we build from there. But the structure of the seminar, I would like to go and keep it as informal as possible. This is a chance for me to get to know you guys. So instead of running it like a lecture when I do the majority of the talking, I'll try to interact with you guys as much as you can, and as much as I can too. There's as much learning in the classroom as outside the classroom. So this is not like a lecture form where me passing on whatever I know, but basically what I do is that I'll bring up the important topics, okay, and that's open for discussion. Okay, so let's have a quick round of introducing ourselves. This is the first finance unit that you have done. Do you have any interest in finance? Is that anything that draws you to the financial markets? Is that because you want to manage your financial affairs? You want to know how company works? Or you want to do some tradings? Is that anything that interests you about these financial markets, and therefore you're taking this unit? And if you want to tell me that you take this unit because your friends are taking it, that's fine with me too. Okay? But let me be very sort of clear about one thing, that finance is a topic that it's not invented by us. It's there for a particular reason. Okay? And the players in the financial markets, they are humans. Okay? So therefore, it will be subject to all of the human bias that we all have. So this course is not far away from, like, say, the arts or biology or whatsoever, because it's about human behavior and how we arrive at a price when we disagree, when we agree about something. Okay, so the market price of something out there. So at the moment, Telstra is sitting at about $4.20, for example. Okay, that means all market participants agree that the value of Telstra is $4.20. So there's an agreement going on that we agree this is the kind of thing. But in order for a trade to take place, okay, so suppose that I want to buy Telstra shares. So in order for me to buy, someone has to sell, right? Okay, so the question becomes why I want to buy, why the person wants to sell. Okay, at the end of the day, finance or trading is a zero-sum game. If I lose, that means you win. If I win, that means you lose. Okay, yeah? So it is a zero-sum game. So in order for me to buy, there has to be a seller. So the reason is, why do I want to buy and why that person want to sell? So the simple answer is, I want to buy because I think the share price is going up. You want to sell because you think the share price is going down. So in order for a trade to take place, we have to disagree. Okay? And then the key question is, who is right and who is wrong? Okay? So you can see that the trading volume in the stock markets is like, it runs for about trillions of dollars per day. It means what? It means that there's a lot of disagreement in the markets. People trade a lot. Every time a trade takes place, there's a disagreement going on. We disagree with each other a lot. And then you're like, hang on, but isn't it we all get so much access to the information? So the more information we have, does that mean that we should agree with each other more? It's the opposite. The more information we have, the more we disagree with each other. And you can ask yourself, right? My generation, we don't fight with our parents a lot because we don't have that much access to information. And then your generation, turns out that you fight with your parents a lot. Probably a lot more than I fight with my parents. Why? Probably you have a lot more information compared to I do. The more information we have, the more disagreement we have, and then the more tradings that I see in the stock market. Okay, so it's not something that is very isolated. Okay, so understanding how the market works, understanding how managers work, understanding how shareholders work, it's deep rooted in the question of psychology, of biology, of physics, and everything, you name it. Okay, so this is fun. All right, so we're gonna go and do a round the table of just tell me your name and any interest you have, any experience in finance you have you traded anywhere, have you bought any stocks, basically why you are here. Okay, very very brief. I don't want to be like a killing experience, right? We're gonna be stuck with each other for about 11 weeks. These days some marriage don't even last that long, so we make sure that we have a good time. Okay, so I'll be the guinea pig, and I'll introduce myself first, right? So my name is Annette, right? I'm the unit chair for this unit. I'm also running the seminar too. So the way that the course is structured is Tuesday from 10 till 12:50, so 2 hours and 50 minutes on campus seminar. I also run an an online seminar for off campus students. So it's basically a recap of what we do in this seminar here. If you already attend the on campus seminar, you don't have to go to the online one. Okay, so it's not like I tell secrets over there. So the seminar is recorded too. So if you want to go and listen to it, it's always available. Now, so what do I do with my life, right? My research area is asset pricing. So it's finance is a very big topic. Okay, in there's a corporate finance, understanding how company works. There's an investment brand, understanding how fund managers work, how to invest. Okay, and within the investment umbrella, there is a sub. Or there is a branch called asset pricing, and the name implies itself that is we are looking for ways to price asset. Okay, so at the end of the day, everything carries a price. Okay, and we don't want to overpay. I don't want to overpay for anything. So how do we work out that price? Okay, so it's a price that everybody has to agree with. How do we come up with that price so that it is fair and it ensures that we don't overpay? Now, the success of the investments is not about what you buy, but it's also how much you pay for it. Okay, so this is what I do. Asset pricing is all I do since the day that I finished my PhD and continue until these days. So I like finance a lot because if you want to go and understand someone, all you need to do is to follow their money. Okay, you watch where the money goes. Okay, sometimes you don't even listen to that person because how do you know whether that person is telling the truth or not? But there's a lot of weight in where the money goes. Okay, so you look at Elon Musk when he goes into the government. And he set up these DOGE, right? Departments of Government Efficiency. So trying to do a cleanup or save the government some money or whatever he does, right? So the first thing, what does he do? Watch where the money goes. Okay? Because it tells you, right? The money has to come from somewhere and it will go somewhere. Where does it go? Where does that come from? Does it sit in somewhere? And it tells you a lot of that stories. From that one, then you sort of reverse engineer, and then you build the narrative. Okay? And that's probably has a lot more truth compared to you collect information on what the person say on social media and so on. Social media is also very important because it reflects the people's sentiments. Okay, what is on trending? What's the popular one? But to get into the meaty bit, watch where the money goes. Okay, so I've done my work. So let's start with the gentleman over here. Yep.
My name is Amitosh, and I have studied Bachelor of Commerce before this, and I have also have a 6 months experience working as an assistant accountant. I'm 23 years old, and I'm just this is my just introduction to finance.
Okay, cool. Yep.
My name's Denise. I'm an accountant, and I'm here because finance scares me. This is I'm not something I enjoyed in my undergrad, so I'm excited to really embrace it this time.
Okay, cool. Yeah. Yep. I'm sorry that you just come in, but you sit on the wrong spot. The next person is you. So we just do a round table introduction about ourselves. Just tell me your name, why you here, any interest in finance that you have. Yeah. Yeah. Fantastic. Yeah. Okay. Cool. Yep. Yep. Okay. Cool. Yep. Okay. Cool. Yeah. Okay.
My name is Arista. I'm from India. I did my bachelor's in economics. This is my third semester. I had two units of finance. So yeah, it's
Yeah.
good.
Yeah. Yeah.
My name is Rashida. I'm from Sri Lanka. I completed a degree in international business management. I have worked as a business analyst.
Okay. Yep.
My name is Sneha. I did my undergrad in accounting and finance. I'm doing my master's of finance out here. Hopefully to do my CFAs.
Okay. Yep.
Hi, my name is Gina. I completed my undergrad in economics, math, and stats. Economics is one of my favorite subjects, and I'm trying to pursue CFA as well. So hopefully my master's degree is helpful with that as well.
Okay. Yep.
Kathy. I'm from the Philippines. I completed my undergrad in accounting and then I had a short stint in business consulting. But I found myself more drawn to finance, so I'm trying to focus on finance.
Okay. Yep. Yeah. Yep.
Yeah, myself Akash. I'm from India. So I've done my bachelor's in business administration in freshers as finance. Then I'm here to do my master's in finance. It was my long interest to do my finance. Finish my master's in finance and get into a financial analyst role.
Okay. Okay. Yep.
My name is Shubham. I'm from India. I was in Sweden. I was working earlier with and I do myself do trading as well. So that's why I'm here in this class because sometimes I make loss, sometimes I make profit. So I want to eliminate the losses from my portfolio.
Yeah. Yep.
Hi, my name is earlier I completed my bachelor's in major in business marketing. How companies work, like how they manage their finances, how to share the
Yeah. Okay.
I'm Mehul and I've done my Bachelor of Commerce and I'm currently enrolled in Master of Finance.
Okay.
Hi everyone, this is Sharat. I'm from India. I've done my bachelor's in commerce and I'm also a qualified chartered accountant in India. So I joined for Masters of Finance. I had experience in the fields of accounts and tax, but I just didn't click a lot with it. So I thought, I want to pursue with finance, and I just like the course. That's why I joined.
Okay. Yep.
Myself, Vidya. I'm from India, and I did my bachelor's in commerce, and I'm here for a finance.
Okay.
I'm also pursuing CMA university.
Yeah.
Hi, my name is Steffi. I'm from Bangalore, India. I completed my bachelor's in finance, and I have 2 years experience at Deutsche Bank. And I've held out my dad in his business regarding finance, so that's where it clicked for me. So I thought I'll continue that for my master's as well. And I've cleared a paper in CMA. I have one more paper to clear.
Oh, okay. Fantastic. Yep.
I haven't studied a subject, so I'm clear through.
Okay. Cool.
Hi, I'm Rahul. I don't have any experience in finance. I come from a marketing background. Finance is something I like, but my portfolio will tell you I'm not very good at it. There's a lot I don't know, so I'm here to learn.
Okay. Cool.
Hi, my name is Danny. I'm doing a last trimester of the student in commerce. I have more than 2 years working in procurement field, but then I found that finance is something very crucial in my life. So I'm trying the way to how I can make informed decision in investment and manage my portfolio well.
Okay. Yep. All right. So for a lot of you, finance is not a completely foreign field. Okay. A lot of you probably have seen it before, have touched it before. It's just you probably want to get into depth. Okay. What is it on about? Where does it lead to? Okay. How the people inside work, right? So in finance, right, there are two big fields: investments and corporate finance. So investments is where trading coming from, right? So we see the point of view as from a fund manager, okay? And fund managers are different types, right? There are different regulations that dictate what should the managers invest in. It depends on the clients. But as me, right, I only see that as if a fund managers, you can be the one that manage $1 billion, or you can be the one that manage, say, $100,000. Okay, so you can be the big guy, or you can be the little guy. Now, does it mean that the trading strategy should be the same? I tell you that is no. Why? A lot of you probably heard of the word scaling, right? I mean, when you're good at something, you should scale it. Okay, if you sell, if you have a very good product in the market, the first thing you do is that you have to scale it. But let me tell you a little secrets, right? Skills cannot be scaled. Okay, this is the things that a lot of people don't want to hear. Is that if you're good at something, doesn't mean if you're good at doing something small, doesn't mean that you'll be good at doing something big. Okay? It's much easier for a manager to earn, say, 20% on a fund that has about $10 million. Okay? But the moment that you manage a fund that is $1 billion, generating 20% is a completely different ball game. So it cannot scale. It cannot scale. That's the research evidence shows. Okay? So it means that there's actually a lot of opportunities for the little guys. Because if I'm little, I can access the opportunities that are not available to the big guys. Why? Because it's not like the big guys don't know about the opportunities. It's just because even if they know it, they cannot execute it. Why? Because the attention is on them. The moment that he trades, he impacts the price. Can you see it? Okay, so something like a Warren Buffett, every time he moves, the market price moves with him. Okay, for us, the little guys, when we move, the market doesn't move. Why? Because the attention is not on us. Okay, so that's investment fields. This is what I do. So that's the first part. Now the second part of finance, and I think is we cover a large part of it in this course, and that is corporate finance. So corporate finance is going inside the company, knowing how it works, and therefore allow you to value companies properly. So first of all, it answers two questions. What do I buy? Okay, and how much I pay for it. Okay. Right? So even if you can work out, right, the best investments in the world, but then you overpay for it, then at the end, it's still a very bad investment. Good companies doesn't mean good investments. Good companies can actually end up very bad investments because you end up overpay. So Yeah, so we cover a lot of that in this course, and basically we go inside the company, look at the structure of it, what are the risks are faced by the companies, and as a shareholders or as a stakeholders, you need to be made aware of that risk too, and then look at a number of ways that companies can manage that risk. Or if you are the stakeholders, is that going to be a risk that is too big for you to take, and then you should just avoid it completely. Okay, so once again, it is a first year level. We're just going to go it as a standard way, but any slide that you would like me to stop and discuss it even further, please let me know. I'm willing to stop so that we gain a bit deeper, because we have a room of I don't know, probably about 30 of you with very diverse experience here. Okay, some of you come from marketing, right? So you probably know about how to market a product that people like. You probably understand a lot about the consumer's taste or consumer's insight, which I don't even know. Some of you coming from, a family business background, and family business is very important, because how would you go about manage that, and what are the challenges that a family business face that is not available to outside companies, and what should we learn from it? Okay, and if you look at some of the world's biggest companies today, like the Toyota or the Samsung, is technically a family business too. Okay, so we'll see how we go. Now, so Cloud Deacon, this is where we do all of the official communication. So any important information, I would announce it on to Cloud Deacon. Any questions, regarding academic matters, please post it onto Cloud Deacon, because I would like other students to see it too. So please, if you have a questions about the materials of this unit, please post it in there instead of sending me an email, because my email box is always full. And if it's on Cloud, I will email it first, because I see it very clearly. Whereas my emails, I have to go and find you to be able to answer. Okay, but if you have personal matters that you would like to discuss with me, please send me an email, and then I'll make time for you. Okay? So the textbook that we are using is the Fundamentals of Corporate Finance. Do you have to buy it? The answer is probably no. If you want to extend it a bit further, you can, but I don't see that it is a must. Okay, so there's a number of copies in the library. If you want to go and flick through it, you can also read it online. So the textbook is very expensive. I don't think you have to buy it, but we have a textbook to go and build our materials on. So calculation, we just do very simple calculation. You don't have to go and, I don't ask it to go and run Python or whatsoever, but you know that there are other more powerful tools, okay? But Excel and calculators are as good as it gets, but to build anything more complicated, you probably need more powerful tools compared to that. So in your own time, you can go and check in how to build code to analyze data in Python, and then so. Okay, so Deakin University in itself, it's also a data center. Okay, we host a lot of data, and we paid a great price for them. Okay, so as long as you are here, you are free to exploit any of the data that we have. All you need to go is contact the library there, and then they will show you. Okay. These days, a lot of the things that we do is data driven, because if you have to go and give advice to somebody, right, it has to be backed up by some sort of data. Because if it's not backed up by data, it means that you're just making it up. Okay, what sort of on what foundations that you are saying it? So a lot of corporate advisory firm, they serve the role because they've got proprietary data. Okay, they've got access to data that other people don't have, and the same as university as well. We paid a lot to get this data, and you have access to them when you are here. The moment you walk out of the door, your student's ID doesn't work anymore. So when you're here, please make the most use of them. But you cannot use them unless you have the powerful tools. Okay, so you have to be able to write code. And these days the AI is really good, right? So those in my in my universities or during my PhD, I spent ages to go and write very simple code of SAS. Now you can just put in a very lousy code, put it into ChatGPT, will fix it for you. Okay, but you need to know what you're doing. That's all it is. Okay, so before I always look at the IT guys with envy, because they write beautiful codes and it runs very efficiently. Why my code is so slow and it just bugs everywhere? But you know what? Now I can just be as good as them. Okay, so a very lousy coder can just look like a very good one, but you have to know somewhere to start first. Okay. Now assessments, right? We have 3 assessments. The first one is online quizzes. We have all the way 8 quizzes going from I think week 2 until week 9. So it's starting at next week. You only need to complete. So if you don't want to do 8 quizzes, you can just complete 6 out of 8, and then we will sort of average the marks out to give you the 10%, okay, of the overall marks. Okay, so more information about the quizzes later. And I also have the information about the quiz on the assessment folder on Cloud Deacon. Now, assessment number 2, that's where it's a practical assignments. It's going on from week 3 until week 8. So I will release the assignment in week 3, the 25th of July, and you have, I think, 5 weeks to do it. So I think including the school holidays, that's going to be 6 weeks to do it. Okay, and so the assignment is due on the 5th of September 2025 at 8 p.m. So the marks will be released after about 15 business days. So it takes us about 3 weeks to marks, and then we'll release it to you after we finish it. Now the final exams, right? All of this is going to be mentioned in the assessment folder too. So the final exam is an online exam. It's an open book, but however, it's a proctored exams. So which means that there is going to be a software which monitors you when you're doing things when you're doing the exams to ensure that you're not cheating. Okay. Now, should I use the AI to do my assignments for me? Okay, should I use the AI to do the assessment for me? Okay, this is like an open secret that everybody knows but nobody talks about. Okay, now, the first thing is, what's the point of the assessment? The point of the assessments is for us to go and build up your muscles. Okay, so that later on when the opportunities come, you know how to fight. Okay, the AIs are very powerful tools. Okay, you have the powerful tools, but then you need to be very ambitious. You need to ask the AIs to tell you how to do the hard things, not the easy things. Why? Because this is the point of the assessments is for us to build up the muscles. But what we see the students do is that they take the assignment or whatever the assessment question, they put into the AI so that they train the AI muscles. So when the opportunity comes, they have no muscles to fight. Okay? And this is what we don't want to see, right? All right, the AIs are very powerful tools, but therefore you need to be very ambitious with the AIs. If you ask the AIs to do the assignment for you, it means that, your ambition is very low. Okay? If you ask the AIs to make money for you, okay, that's where you have a very big ambition. Okay? All right? Because it's a very powerful tool. It's such a lot better. Okay? Now, I have a friend who he told me that one way to invest in a market which he is very familiar with is that the performance of the company depends on the policy of the government. Okay? I'm sure that you guys know this, right? Right. So in addition to how the managers works, how the investors work, how the market works, you come up, whether your goods and services are appealing to the markets. You also have to watch another guy, and that is the government. Okay, and the government by itself can impact the performance of the companies too. So he said before he used to He used to have to go and ask his friends who work in the government circles to tell him what the news are. Okay? But then now he doesn't have to do it anymore. Why? Because he's got the AI to read the government policy much better than anybody. So he said, I don't have to have insider connections anymore. I just know what questions to ask, what documents to search. Okay, because after all, the governments have to communicate, Okay, they probably don't communicate with anyone, but they have to communicate somehow. Okay, so if I'm just saying that if you want to use AIs, at least be more ambitious about it. Okay, compared to just want to get a HD for your assignments, that's kind of low. And the thing is that the purpose of the assignments or any of the assessment we have here is to build it from easy to tough, so that it builds up your muscles, and then you see how the markets works. You go and do research yourself, so that later on you can exploit these powerful tools to your advantage. Not how to write an email to my boss. How to write an email apologizing to my boss that why I am late for the meeting. This is the things that most people do now. But anyway. Okay, so how to perform well in these units? The usual stuff. You read all of the allocated textbook chapters before the seminars, but the thing is that you just use the seminar slide as a guide. Okay, any questions that you want to explore, you can refer to the textbook or go to Google to search it whatsoever. But when you go and use the AI to search, make sure you have to ask it to cite the source. Okay, because if it comes from a reliable source, coming from an industry expert that has a very long time experience, coming from a big guy in the market, or coming from a professors at a university, that source, or coming from like a economic policy of the government, that sources are probably a lot more reliable compared to some sort of hotshots influencer, right? And you can there's a lot of the AIs there at the moment. You've got the ChatGPT, you've got the Gemini, and DeepSeek, or whatever it is, right? So and then Grok, right? So each one of them have a different weighting scheme. Okay, and then if you ask the same question to different AIs, it will tell you different answers. Then you can sort of understand how the AI works. What sort of weight does it give to? Now, a lot of the intelligence tool gives a higher weight to policy documents, whereas another one can give a much higher weight to social media contents. Now, which one do you believe? Okay? So, yeah, you have to go and use it wisely. I mean, I don't want to go and give advertising to these people, but it's on the market. I know you guys are going to use it, but make sure you use it wisely and understand what the purpose of the assessment is. The purpose of the assessment is that later on you can put more intelligent questions in the AI box. Okay, that's the whole purpose if you want to use it. Okay, now let's start. Okay, see, the only way to understand a company is I see it from the point of view of someone working inside it. Okay, so I'm not gonna go and see company from an investor's looking in. I'm gonna go and see the company from a manager looking out. Okay, so what does a manager do in a company? Okay, so the role of any financial manager is to maximize the value of the company and maximize the wealth of the shareholders. Okay? So this is an unwritten rules that prevailing the business world for, I think, since the days of Adam Smith in the Wealth of Nations, right? So as a manager, right, whatever I do, the questions I ask myself is, does my action lead to increasing in shareholders' wealth? If the answer is yes, I'll do it. Okay, and if the answer is no, then I won't do it. Okay, so this is also like a statement that gets the managers outside of trouble, even if they do something wrong. Because in the eye of the law, if they stand in front of the court and all they can justify is that, my actions might be wrong, but at the same time of making the decisions, I am acting in the best interest of the shareholders. Sometimes they are off the hook. Okay, because this is what managers do. Okay, trying to create the wealth of the shareholders. I'm not responsible for anyone. All I'm trying to do is to increase the wealth of the shareholders, maximize the value of the firm, and therefore maximize the wealth of the shareholders. Okay? Now, so that's the first objective, but later on, they are also responsible for other stakeholders. So this is where other managers, the managers themselves, so they are responsible for the shareholders, but they're also responsible for themselves. So the way that they are responsible for themselves is through salaries and bonuses. Okay, sometimes they are excessive, but this is how they justify their actions. They're also responsible for other employees. So just because you maximize the shareholders well, that means you should underpay your workers. They also they're also responsible for the creditors, the people who lend the monies, the suppliers, the one who supply them with the goods and services to build their products. And last but not least, they are responsible for the governments in the mechanism of paying taxes. So, what does a firm do? Now, a firm will generate cash flows. Okay, as a company, I'm not there for fun. What I'm trying to do is to generate net cash flows by selling goods and services produced by its productive assets and human capital. Now, this is a classic case of what we call capitalism. Capitalism is about the mix between capital plus labor. Okay, so I have capital plus labor turns into a product, either in the form of goods or services, sell it to the markets, okay? As long as the selling price is higher than the cost that you pay for them, therefore you have the net cash flows, okay? And the net cash flow will flow back into the company in the form of investments or other things, right? So it comes in very interesting in our modern world, right? So that was how it's always has been. Okay, I have capital and labor becomes the goods, sell it to the markets. Okay, now you have the AIs, right? So which one is capital? Which one is it's labor? Okay, so okay, if I have you probably sitting there, you do some job, right? So before that was counted as labor, but then now you use the AI to do the job. So is that labor? Is that labor or is that capital? You don't know. Okay, so it becomes like the blend now. It's the things that separates them between capital and labor to look very fuzzy, right? You don't know which one is labor and which one is capital anymore. But I just want to mention it's there because that's what capitalism is all about, right? So you have capital, you have labor, you add them together, that's it. You have the goods and services, you sell it to the markets. Hopefully you do it well, and therefore the cash inflows are higher than the cash outflows, and therefore what you have is the net cash flows. Okay, if you do it well, the net cash flows will be positive. Okay, if you don't do it well, the net cash flow will be negative. Okay, and what does cash count in a business? Okay, so you have a business that made up of whatever the components, the machinery is like different organs in your bodies. But the way that the cash functions is that it's like the blood washing through your body. It's a circulation. Okay, blood has to circulate. It has to flow, just like cash has to flow. Okay, it has to flow from, I don't know, but we're going to go through the cash cycles in a minute. But it's just like the cash has to flow. Okay, now, if you are a company and consistently your cash outflows is higher than your cash inflows, what does it mean? Yeah, it means that you're bleeding. Okay, you're bleeding. Right? Your cash outflows is higher than the cash inflows, means that you're bleeding. So what do you do when you bleed? Number one, you stop the bleeding. Okay? So you have to stop the cash outflows somewhere. Because you know that if you keep on bleeding for 6 months, you're going to die, even though your organs are still functioning. Okay, so your heart and your liver is all functioning, but if you keep on bleeding, you're gonna die no matter what. All right. So when you bleed, what do? Number one, you stop the bleeding. Okay, you have to stop the cash outflow somewhere. And the thing is that if you bleed too much and your blood is running really low, what's the next thing you do? Your blood is too low. You're in the hospital. Your blood is too low. What do? Yeah, you get a blood transfusion, right? So in here, it's the same. If my cash is too low, I have to go and get the cash from somewhere. Okay, either borrow or get it from the equity holders or whatever it is. Okay, you have to get the cash from somewhere to go and support the business to make it keep on going. Right. So what matters is the residual cash flows, right? So what do we do with the residual cash flows? Okay. So here is a company that makes up of all of these things are like the organs. Okay. So for example, you have the current assets, that's the cash, the inventories, the accounts receivable. So these are the current assets that are responsible. I mean, a lot of you guys are accountants here, so I'm not gonna go and pretend to be the expert. Okay, so the current assets are probably the assets that help the business in the short run. Okay, whereas in the long run, it is the one that is responsible for goods and services, the productive assets. So the plant, the equipment, building, technologies, and patents. Okay, so where do your cash go? All right. So first of all, if you have the cash flows that are generated through the sales of goods and services, it will go through the companies and it will pay. Okay, so some of that will be used to pay the assets in the form of investments. Okay, some of that is gonna go and be used to pay the salaries. Okay, and other expenses. Okay, so cash paid to managers and other employees, cash paid to suppliers, cash paid as taxes, cash paid as interest and principal, and hopefully after you make all of the cash payments, and you better go and keep track of them, you have what we call a residual cash flow. This is what we call the net cash flows. And this is what we use in a lot of our valuation models. Okay, so what are we interested in is not the revenue or the profit or whatever whatsoever. What we interested in is the residual cash flow, the net cash flow. Okay, so for us, profit probably doesn't count as much because profit is non-cash. Okay, what we want to go and do is always a net cash flow. So where does it go? What do you do with its residual cash flows? Now, some of it you can go and reinvest it back into the firm. Some of it you can just put in the cash balance. Why? Because you want to go and have some cash waiting there in case if you've got future opportunities which you want to fund. Now, after the GFC, a lot of companies are holding cash. Okay, so Google is loading on a lot of cash. And why? Probably for future buyouts. Probably there's a lot of risk going on. There's a lot of uncertainty going on. Okay, and therefore they want to go and keep the cash there in case something is wrong. And if you still have the cash left over, okay, you can work it out how much cash you want to go and keep inside the company for future investments, and some of it you probably want to go and pay it to shareholders in the form of dividends. Okay, so the question is how much to pay out, how much to keep in. Is a question of a dividend policy, which we'll go through later on. Okay, now when I first started my PhD, right? My supervisor tells me something that I never forget, and I will share it with you guys. And he said, you will see the invisible world in the visible world when the visible world does not close or cannot close. Okay? Because as us, the little guys, we have to look for opportunities. We have to look for what we call market anomalies. How do we find them? Okay, you have to go. Can you see that the cash cycle here, it is closed? Okay, it's a system that is closed. The money has to come from somewhere and it will go somewhere. It has to circulate. It has to close. The moment that it doesn't close, okay, it means that there is an invisible force that is going on. Okay, and it may be that it is something that you want to know, or it may be it is an opportunity. Okay, but you need to know how the system works, how every little pieces fit in, and it has to close. At the end of the day, it has to balance. Okay, things have to balance, have to add up. If it doesn't add up, it means that there's an invisible world that is going on. It goes somewhere and somewhere. Okay, this is not only true for the cash cycle; it's true for everything else. Okay, in the investments opportunities, this is what we're looking for: market anomalies. Okay, so when I was doing my research, when I was your age doing my research, I was always interested in the model and how everything fits in. Okay, and what does the model say? Okay, I hate outliers. Okay, because the outlier standing there means that my model doesn't work. It cannot explain this little thing in there. Okay, I hate it because it means that my model doesn't fit. There's something wrong with my model. Okay, and then it just makes my argument less convincing. But as I get older, okay, I'm interested in that little outlier there. Okay, because everything just works according to this model here. But there's one thing that doesn't work. So you want to know why it doesn't work. Okay, and maybe it presents an opportunity. Okay, so this is why, as I say, that you need to go and learn what to do with your data, because it will show you the pictures very clearly. It will show you a system that is closed. And once you see a system that is closed, you see where the little door is, where it doesn't close. Okay, because as a little guys, right, we have to play with the market anomalies. We can't sometimes we can't we can't earn the things that the big guys do. Now, so as a financial managers, what are the decisions do I make? Okay, so your job as a manager to maximize the value of the firm. Okay, how? How do you maximize the value of the firm? If you have to go and run a business, what are the things? So if I start a business selling fried chicken tomorrow, okay, what are the decisions that are most important that maximize the value of my business? So basically build the best goods and services. Okay? So build the best goods and services. What do? The best capital, the best labor. Okay? Capital plus labor. Okay? You get the best people, and then you get the best capital. Keeping in mind that you pay the right price for it. Okay? Because at the end of the day, it's a net cash flow that you are looking for. Okay, you're not gonna buy the most expensive capital, hiring the most expensive people, and then at the end your net cash flow is negative. It doesn't make sense. Okay, so it's about getting the best and paying the right price for it. Okay? It's not like underpaid people. That's not gonna work very long, but you pay the right price for it. Okay, so that's the first decisions, the investment decisions. Okay, which productive asset should I buy? Okay, and it's true for every single business there. Okay. Go for the best capital and the best people, subject to your constraint. Okay. Now, the next thing is, where do you get the money from? Right? You're gonna go and hire the best people, get the best capital. The money has to come from somewhere. So what do you do? Where? You get a loan? Yeah? Yep. So your personal investments, and when you invest your own money in, that counts as equity. Okay? So your own investments in, that counts as equity. Okay? So I want to start a fried chicken shop. The first money comes from me. Where's the next dollar? Okay, so after about 2 weeks, my money runs out. All my savings gone. Where's the next dollars coming in? The bank loan? Okay, so when you go to the bank, what do they care about? Sorry? Yeah, the bank cares about two things. Okay? So what does the bank care about, right? From the bank's perspective, what's the most important for them? Yeah, you better pay the interest and then the principal back. Okay? So so they don't care about your profit though. Why? Because you do well, they don't benefit. Okay? They don't care whether how much you grow. So all they care about is that you have the ability to make interest payment. Okay? So what sort of business that the banks like? Sorry? Some sort of business that give you stable cash flows. Okay? They don't like the one that makes $0 today and then $10,000 next month. That's too volatile. Okay, so the bank probably only like stable cash flows. If you want to go and ask the money from the bank, cash flow projections is what they care about. Okay, if I have all of the receipts, like this is how many chickens I sell per day. This is the revenues. This is the expense. Very stable cash flows. 150 customers per day from Monday to Friday. That's the kind of things that they like. Okay, but if I open a cosmetic firms and today I don't sell anything, and then during the Valentine Day I sell 10,000, they probably don't want to hear that. Okay, and the next thing that they probably like is the quality of your collateral. Okay, so if you have things like land, machinery, they probably like it very much. But if you have something like I have this secret formula about my fried chicken recipe, then that counts as an asset to me, but it doesn't count towards them. Okay, so the next decision is where you get the money from. And last but not least, very important one is a working capital management decision. It's about how do you manage your cash flows. Exactly the things that we talk about. We're gonna go through it later on, but it's managing between current asset and current liabilities. Because you can be a very profitable business, but if you do not manage your cash flows well, you die anytime. There's a lot of examples about it. I think I can't remember what's the most current bankruptcy we face, but I think there was this chocolate brand. It's called Cocoa Black, and it was a very profitable business, and I think at one point it had to go into receivership because it was growing very quickly. So the cash inflows, even though it was growing, but the company is expanding very quickly. So when you have one store that was doing really well, the next thing that you wanted to do is that you open about 15 other stores to take market shares. Okay, a lot of companies do that. So so if I have one fried chicken shop, I do it really well. So the next thing I want to do is I want every single suburb, in the 30K radius, there has to be a chicken shop. Okay, so I open it really quickly. Okay, so what you happen when you open up really quickly is that your setup cost is very high, your cash outflows is really high, whereas your cash inflows is not quick enough to go and cover your cash outflows. So the next thing that you know is that you are not able to pay your lenders. And you know what? Lenders are the one that can force you to go into liquidations. Okay, you get your money from your parents, you don't pay them back, that's okay. They cannot force you to shut your business down because that's equity. Equity holders cannot force a company to go into liquidation or file for bankruptcy, but lenders can. Okay, but you borrow the money from the bank, you don't pay, they force you to go into liquidation, and that's not going to be fun. So so net working capital is the difference between current asset and current liabilities, and therefore and need to deal with it very carefully. Okay, so here is the balance sheet of a company, all right? And so like the debit side has to balance with the credit side. when I was doing my accounting unit, I always said debit is better than a credit. So that. But all right. So here are your assets. Okay, this is on the debit side, right? You've got the current assets and a non-current asset. Okay, what are your assets funded by? Okay, so they are funded by current liabilities, the short-term debt. They're funded by non or long-term debt, and they're funded by equity. Okay, so in terms of cash flows, this is how it has to circulate around because it has to add up. Okay, so you are going to use your assets, right? Generates cash flows. Okay, your cash flow will be used to go and stuck in these liabilities, long-term debt, or shareholders' equity here, because retained earnings, even though if you don't pay dividends, retained earnings is counted as equity on your balance sheet. Okay, has to add up. Okay, so the investment decisions is the capital budgeting decision is the most important one, and it's about identifying which productive assets that the company should buy and how much they can afford to spend. Okay, so inside the company, right, this is the decision that the managers makes. Okay, in order to go and have and create the products and services to bring it to the market. Okay, so it's really funny that assets, like the land, the machines are counted as the assets on the balance sheet, but then the human capital is counted as an expense. Okay, so even though there are a lot of information in your balance sheets, but it may not tell you everything. So that's why you look at some technology stocks, right? The price is very high relative to the book value. Okay, whereas you look at companies like they own a supermarket chain, price to book ratios is very low. Okay, so the Google, the Apple, the Microsoft of the world, you look at their book value. Okay, it's very low. Their price is very high, so the ratio of price to book value is very high. Whereas you look at companies like the supermarkets, like the Coles and the Woolworth, or the airlines, right? Price to book ratios is very low. So that means your price is not that different to your book value. What is that going on? Does that means one stock is a lot more expensive than the other? Does that mean that the technology stocks are overpriced? Too expensive? So I've got two companies here. One has a book value of $10, or both of them has a book value of $10. One has a price of 100, the other one has a price of 20. So what's that going on? So the Google and the Coles group. Okay? Google versus Coles. Technology versus supermarket. Okay? Both has a book value of $10. One has a price of 100, the other one has a price of 20. Why is that? Yeah, so it's just saying that price to book value, it means that, for Google, there's a lot more growth. Okay, so there's the price reflects the growth opportunities there, whereas price to book value of Coles is saying the market hasn't factored the growth in, or it's saying that this company hasn't got any growth opportunity left, so therefore the price is low. That's one explanation. What's the other one? Okay, so in order to get goods and services out, you need what? Capital plus labor. Capital is recorded on your book value. Labor is not. It's on the profit and loss. Yeah, so labor, your human capital, doesn't appear on your balance sheet. You have a lot of talents in your company, and it doesn't appear on the balance sheet. It appears as an expense on the profit and loss. So what does it mean? It means that the rules of accounting maybe is not applicable to tech stocks. Okay? Because they have high price to book ratio because their book value is too low, because the human is not there, because the majority of their assets are in the form of human capital, which is not recorded. Okay? So once again, right, you see that something doesn't add up here. Okay? Something that is very wrong here. Okay? Doesn't make sense. How come it's not only that Google is the only one that has high price to book ratio? Microsoft also has high price to book ratio. Facebook also have that. Okay? All of these tech stocks, right? They all have high price to book ratios. Are the markets all wrong for these companies collectively? They're all wrong? Is there something that's fundamental that's going on? Yes, they have a lot of growth opportunities, but maybe the rules of accounting is probably out of date for them. Okay, so the accounting standards, when you prepare the financial statements, you have to go and stick to the accounting standards. You cannot do whatever you want. This item is recognized as an asset. This item is recognized as a liability. This item is recognized as a revenue and expense. There's rules for everything. Okay? And what's the purpose of the rules? The purpose of the rules is to ensure that consistency, no cheating going on, and it's designed to protect the interests of the non-informed traders and sort of whatever so on, but doesn't mean that the rules is applicable to everyone. Okay, there are always the exceptions. There are always things that the rules don't work for them. Okay, you can't have a rules that gonna go and apply to everybody, and therefore there's an opportunity. Yeah. Okay, because everybody else, every companies, when they record the balance sheets, have to go and follow the accounting standards, a certain way. Okay? Now, so financing is how companies raise cash to pay for their investments. So, you can get the money in the form of either debt or equity. Okay, so, let's bring up another important, very important topics here. Okay, so you guys are probably not you guys probably Gen Z, right? Yeah. So a lot of you probably Gen Z, right? So when you Gen Z, I'm sure that you're very aware of crowdfunding. I don't know. All the buzzword that is going on, NFT and all that, right? But there are only two types of assets that are recognized by the law. Okay, so what is a financial asset? Okay, so you have a real assets here. Okay, so real assets are the one that create cash flows. Okay, what about financial assets? So financial assets are the shares and the bonds. They don't create cash flow. They are pieces of papers. What they represent is the claims on the cash flows that the real assets produce. Okay, so when I own a share of, say, NAB, the National Australia Bank, okay, I don't own the buildings. I don't own whatever the machines in there. But what I own is the claims on the cash flows produced by that buildings. These are the rights, my rights, and the obligations of the companies are written by the law. The companies cannot get out. Right? So anybody who wants asks you to put money and invest in something, you ask yourself, do I become the equity holders or do I become the debt holders? Okay? Because if you don't become either one of those, you fall outside the law. Okay? Anything happens, then nothing to protect you. Okay, so for example, these are what we call financial securities, and therefore we have security laws that govern how they operate. Okay, so if you look at the case of Sam Bankman-Fried, you've heard of it. You know have you heard of it, Sam Bankman-Fried? Yeah, you guys can go and look him up. So technically is that he has this exchange that allows you to trade crypto. Okay, so bitcoins and any crypto assets. Now the thing is that when and later on it turns out it was all fraud. You send the money in and then he take the money and invest in somewhere else, and then at the end when you ask your money back, he has no money to give you back. But the thing is that when you use your money to buy crypto, we don't know whether that is asset, whether that is equity or debt. We don't even know whether crypto assets are securities or not. Because if it's a security, it would fall under the security law. But because we can't say that whether it's a security or not, it doesn't fall into the security law. So a lot of the small investors lost money because the law doesn't have a provision for them. They don't fall into the net. So what are we going to do? Okay, so yeah. So financing is how companies raise cash to pay for their investments, and they're coming in two strict flavors, either equity or debt. Equity represents ownership. If you hold a debt security, it means that you are the lenders. Okay, and then therefore it's in the obligation of the rights and the obligation of each parties are clearly written. Okay, so the goal is to determine the combination of debt and equity that minimizes the cost of financing the company. In here is the same thing, right? Now, when you purchase the assets, okay, I said that you buy the best capital, the best labor, subject to your constraint. In here is the same thing. When you get money from someone, okay, make sure that you have to minimize your cost of financing. Okay, I'm not gonna go to a loan shark to go and borrow the money with an interest of say 20% per year. It doesn't make any sense. Okay, or if I have a very good business ideas and the bank doesn't like it, and when they don't like it, they will charge me a killing interest in order for them to lend. Well, in that case, I shouldn't go and seek money from the lenders. I should seek money from the equity holders. Somebody appreciates you, and therefore it will charge you a lower cost of financing in order for them to fund it. Okay, that's why I'm saying that no one wants to go and invest in their reputations, right? So when you need money, will be the people that know you the best, who will give you the money with a very much lower cost. Why? People will charge you a very high interest or very high cost of funding if there is a lot of uncertainty going on. Okay? But there's the less uncertainty, the lower the risk, the lower the cost of funding. Okay? We'll go through that later on. Okay. So debt and equity, there are two classic forms of financial securities. So these are the financial securities that are written in security laws, and they are protected by the law. So this type of financial asset, they're not like the tangible assets themselves. Do not create cash flows. What they do is that they represent the claims on the cash flows which the companies generates. So for example, I open a fried chicken shops, okay, and then in order to go and fund my assets, you lend money to me and you become the lender. She becomes an equity holders by purchase, say like a 50% stake in my company. Okay, so technically, right, you don't own any of the assets, right? So you can't go to my business and say, hey, I lend you the money, so therefore I am allowed to take this table. No. Okay? You cannot take my assets directly. What you have is that my business will generate cash flows, and then you have a claim on the cash flows that I generate. But you cannot take the assets that I have unless I breach the law or something. Okay? So working capital management is how you manage your current asset and current liability in order to go and keep your cash flows going. Okay, so the net working capital is the difference between current assets and current liability, and mismanagement of working capital can cause the company to default on debt and become insolvent. Okay, so this is exactly what we're seeing in practice too. Okay, so a company does well, okay, and then it wants to expand very quickly, because I have to go and get the market share. Market share is all you heard about now, right? So I have to go and quickly to go and get as much as a share of the pie, as much as possible, not understanding the fact that if you open it very quickly, okay, your cash burnout rate is going to be very quick. Your cash inflow is going to be really slow because you're still building up your reputation. And at the end is that it can crash, okay? So net working capital is the difference, the dollar difference between current asset and current liabilities. Okay, so if you have high current asset and then low current liabilities, what does it mean? High current asset, low current liabilities. What does it mean? Good or bad? Sorry? Good, right? You're not going to be in trouble. Okay, so high current asset, low current liabilities, that means you have a lot of liquidity going on. You're going to have enough current asset to cover your short-term debts when they fall due. Okay, so good, it is kind of good. You're not going to be in trouble. There's no bankruptcy in the near term. But too high, is that good or bad? So very high current asset, very low current liabilities.
It could be bad. It could be bad because like it seems like you have like a lot of inventory and accounts receivable as well. You have the money back.
Yeah. So current assets are the ones that with what we call the very low yield. Okay, the return on the current asset is very low. So what are current assets? Okay, account receivable, cash, and whatever inventories. Okay, all of these, the yields are very low. The returns on them are very low. So basically, if you're gonna keep them on your book, yeah, so it doesn't hurt you. But for inventory, for example, you keep them for too long, it increases your warehouse costs and all these things that's going on. You have account receivable that is too high. That means that people have owed you money and they haven't paid you back yet. So that's not good either. And you have a lot of cash stuck in there, and cash doesn't earn much returns. Okay, you put your money in the bank, how much returns are you getting? Okay, so too high current assets, that's not good either, because current asset by their very nature, the yield is very low, the return is very low. So you are earning a very low rate of return on your investment. Okay, but too low, that's not good either. If you have a lot of current liability and very little current assets, that means that you probably be in big trouble in the very near term. So you can see that there's a little bit of a sweet spot going here. Okay, there's a little sweet spot that maximizes the value of the firm. Not too high, not too low, just right. Okay, now the forms of business organizations, right? So, say about before company started, I can't remember when was limited liability company started. I can't remember, but sole traders was the longest type of business organization that ever existed in history for a very long period of time after companies comes into being. But you know, in our in the medieval times, okay, that's how it was done. Okay, so it's a very simple way for me, for anyone to start and operate a business. So what does a sole trader do? I start my chicken shop. Okay, and you know, I sell my chicken chops, and therefore from the eye of the law, there's no separation between me and the chicken shops. Okay, so if my chicken shop doesn't pay the lenders, which is that doesn't pay the lenders, that means the lenders can go over here and then take all of my belongings to cover the debt. Okay, so for example, like you can take my car, can take my TV, can take my house, whatsoever. Okay, so the thing with a sole proprietorships is that all the risk and profits are kept inside the business because the owner and the business, there are no separations between those two. Okay, so I am just as good as the business that I operate. Okay? The good things about this is in the form of tax is very good because all of the business incomes is taxed as my personal income. All of the business loss is viewed as my personal loss. So if I have another source of income, I can just use it to offset my income to. Yeah, so I can use the loss from the business to offset the income to lower my tax. But the horrible things about the sole proprietorship is that it has unlimited liabilities for all the business debts and other obligations of the business. Now, what's the biggest disadvantage of this form of organization? What do you think? Clearly, the unlimited liability, right? But what's unlimited liability will lead to? Do you want to become the shareholders or do you want to become the owner of my chicken shop? Yes or no? Why? Yeah. So that means if he wants to go and give me the money to expand my chicken shop because it was doing very well, he would probably not gonna do so. Why? Because if I do badly, I fail, he will also be responsible for my debt. You see it? Because now he becomes one of the owner. Okay? So I have this chicken shop is doing very well. And then I go and I ask him, hey, I want to go and open another chicken shop. Okay? Because you see, the first one was doing very well. Can you give me the money? And he say, no. But I'm doing so well. No, but if you do badly, then I am responsible for your debt. Okay? So it's very tough for this kind of business to raise funds. If you cannot raise funds, you cannot grow. It's very hard to get growth. Okay? So yeah. So partnerships, right? It's a next forms of sole proprietorships. Okay? So instead of having one owner, you have two. So if you contribute the money to my chicken shops, that means you and I are now become the partnerships. Okay, I'll do all the labors, the run around. Okay, and then you can be the one who contribute the capital. I'll contribute a little bit of my own, but the majority of the capital come from you. Okay, and then but still he will say no. Okay, because partnership will also have unlimited liability. Okay, so even though I invest I contribute 20% of the capital. Okay, or he contribute 80% of the capital. Now my business falls under. I take a plane, I fly out of the country. Okay, so he goes. The lender goes and knock into his door. He goes, okay, I'll pay, but I'm responsible for 80% of the business. I'm responsible for 80% of the debt. The lender say no. You're responsible for 100% of the debt until I find your partner. Okay? So you're not only responsible for your share of the business, you're responsible for your partner shares of the business. And that's not fun. Now, companies is a very, very next steps. It's like a advanced form of business organization from the other two. Okay, because it's viewed as a separate legal entity. Okay, it can do whatever a person can do. It can also borrow. It can also lend. It can also enter contract. It can hire people. It can sack people. It can do whatever that a person can do, except for the fact that as the owner, you are only responsible for your share in the company. Okay, so the shareholders have limited liability. Okay, so what those limited liabilities mean? Okay, I'm responsible for my share only. So worst case scenario, I buy the shares for $5 per share. Worst case scenario, it goes to zero. And that's about it. I lose all of my money and that's it. I walk away from the deals. I'm not responsible for the company's debt. Okay? Shareholders are not responsible for the company's debt. The most that they can lose is the amount that they pay for their shares, and that's about it. Now, the companies are regulated by ASIC, okay, and by the Corporation Act 2001. So you can clearly see, right? If shareholders can walk away from the deal, leaving debt holders there, okay, what is the incentive for a company to do? And shareholders to do. Okay, so I start my chicken shops here. Okay, 20% of the money come from him, 10% of the money come from me, 70% I borrow. Okay, my business falls under. He lost 20%. He lost all of his money, but that's 20%. I lost all of my money, that's 10%. The lenders now get zero. And they contribute 70% of the money. Is that fair? Is that fair? Fair? Yeah, so it's fair to us. Yeah, it's fair to us. But the thing is, if you think about it, right? 70% of the money come from them. We only contribute a little bit. We are when we were running it, we were in charge of 100%. 70% of the money come from them. So that fair? Yeah, to us, but not to them. So you can see that how can, I thought fairness is an absolute thing. How come it's fair to him? It's not fair to the lenders. To us, it's fair. To them, it's not fair, right? You should have done, the lenders should have done the homework. We did the best we can. You know, when I started my chicken shops, everybody loves chicken. And the moment after 3 months, people wanted to switch to beef, and there's nothing I can do. You know, it just happens. Now, but the incentive of limited liability is that it encourages managers and shareholders to take risk. Okay? Take massive risk. Because if we take risk, if it's good things, we benefit. Bad things, the lenders foot the bill. Yeah? So I'm not interested in low-risk project. Yeah? If the business is funded 70% debt, 30% equity, and the equities and the managers, myself included, are the one who run, guess what? I'm not interested in low-risk projects. Why? Low-risk projects pays very low. So the majority of the money is just enough to cover the interest payments because the debt is very high. Yeah? But what happens to high-risk project? High-risk projects means that if it pays really well, I benefit. If it pays really low, the lenders foot the bill. All right. So it really encourages companies to take risks. But clearly the lenders are not stupid. And after a little while, the legal system is not stupid either. Because every time when a company does something wrong, they take each other to court. The court writes it down. It becomes the rules. Okay? And every time when you have a crisis, that's where the legal system gets involved. They're just gonna go and rewrite the law every single time. Okay? So we have the Corporation Act in 2001 to regulate companies there, because at the end of the day you can take risk, but if they can sort of establish that you take risk for the sake of it, you know that it's a very risky investment going on, you take it to your advantage, to the shareholders' advantage, and then hurting the lenders, then I think you're going to be in big trouble. Because at the end of the day, there is debt holders and shareholders protection, and it's subject to different countries as well. So for example, I think in Australia we have a stronger debt protections compared to some of the European countries. So it depends on the countries that you operate on. Some countries have very strong law regarding to debt holders protections. Some other countries have much stronger legal system for shareholders protection. So just check your thing. Okay, but limited liabilities companies, right? Now it's like the norm. Okay, it's like PTY Limited is like the norm. But if you trace back into history, right, it wasn't the norm though. If you want to be a limited companies back in the old days, you need to have a charter from the government. Okay, because if you don't give people limited liabilities, there are certain risks that the governments want to happen, and without limited liabilities, companies do not do it. Okay. So managing the financial functions of a firm. Okay, so the CEOs manage the day-to-day running the business. What does the CFO do? Okay, so anybody who is familiar with CFO functions inside the firm? So what does the CEO do? Yeah, so CEO will be the day-to-day running of the firm. So at these days, you've got the CEO, you've got the CFO, and then you've got the CTO, and then also you've got the chief operations. Okay, so yeah, so CEOs is the one who runs the business, so the one who creates the visions of the firm and makes that visions to come true. Okay, the one who is in charge of what products am I selling. Okay, in terms of you can think of Elon Musk or whatever, the one who is in charge of the products. Okay, visions of the firms, and then turn that visions into a reality. Now CTO probably in charge of the tech, and CFO in charge of the finance stuff. Okay, so what is the finance? And now we have the operations as well. The chief of operations. Okay, before the CEO will do all of the operations and the product. Now you've got a separate person to run the operation, and you were like, why is that the case? Because the legal system makes it so complicated for the CEOs to run the operations and comply with the law. Okay, and comply with the law, and then a lot of CEOs like, my time should be thinking about the customers and the products. My time should not be how to deal with the law. Okay, can I get a person to deal with it? Because the law just balloons up, and then you need a separate person. Okay, CTO is the one who is in charge of the technology, and CFO in charge of the numbers. Okay, so this is the treasurers, right, who look after the collection and the disbursement of cash, see where the cash flow is coming off from, where's the cash outflows coming out of, invest excess cash, raises new capital, handle all of the foreign exchange reserves, oversees the firm's pension funds managers, risk managers, manages companies' financial and commodity risk, controllers, prepares financial statements, accounting system, tax, external auditors, and so on. And then you also have the internal auditors within the firm that is responsible for risk assessments and then audits of any high-risk areas. So, if you are the investors of the firm, okay, and you're thinking that these firms, I have money to spend, I want to go and invest in these companies, who would you want to speak to? Who do you think investors usually speak to? Who do investors usually speak to? I mean, we must see it on the news, right? So when the media, okay, they interview someone inside the firm, who do they usually interview? Okay, so when you interview a company, a representative from a company, who do you think the media usually interview? Sorry? Yeah, they usually no. The board is different one. Okay, they usually interview the CEO or the CTO. Yeah, CEO have plenty of stories to tell because it's all about their visions. It's about the exciting bit. Okay, the things that they bring to the market. CTO is about the tech. Okay, and that's the story sell. Nobody wants to interview the CFO. Very few. Why? Boring. Numbers. What does it mean? Okay, now if everybody wants to interview the exciting guys as an investors, there's an opportunity for you to sit down with the boring guy. Right? Yeah, turning your visions into reality is hard. Okay, at the end of the day, the numbers have to make sense. If you want to go, when you want to go and invest in something, right? The first thing that you worry about is fraud. What about if the person tricking you? Okay, you don't worry about the return on your capital. You worry about the return of your capital. Okay, I don't worry about the 25% or 50%. I worry about whether I get my money back. Okay, how do you know the person is not cheating you? So I worry the first sign is fraud. Okay, and the CEO and the CTOs will have plenty of stories to tell. And then your emotions gets up. You have this fear of missing out emotions. If I don't invest now, other people will. And then they always tell you that. They have these managers, they have these funds waiting, they have lots of investors waiting. You don't put money in. You know, this is the last round. I'm doing the last round of Series B. There's only a few spots left. Okay? Nobody wants to interview the boring guys. Okay? So if no investors want to interview the boring guys, maybe there's an opportunity for you to interview the boring guy and see what it means. Okay? If there is a fraud going on inside the company, okay, so CFO will be the first one who finds it. Okay, why? Because he or she has to produce what we call cash flow projections. Okay, so 5 years of net cash flow from now. So in order to go and have a cash flow projections, you also have to see, okay, where's the cash inflow coming from? Where's the cash outflow that's coming out? Okay, now these are projections, so they are not real. So therefore, you have to go and make a lot of assumptions in order to justify that numbers. Now, if the CEO is going to go and tell you that, we expect that within the next 5 years, we're going to be able to sell 5 million units, bringing a net revenue of, say $1 billion. Okay, at the end of the day, do the numbers make sense? Okay, your assumptions make sense. Okay, because in order to go and produce these cash inflow projections and cash outflow projections, you need to go and put assumptions here. How many units you expect to sell? Okay, what price you expect to sell it? When you expect it to come to the market? Where you expect it to come to the market? Who your buyers are going to come from? Okay? The CFO, at the end, he will have to go and make up a stories, and that stories have to add up. It has to make sense. Okay, in terms of cash flows, it has to make sense. Okay? So if there is fraud going on inside the company, the CFO is always going to be the one that detects it first, because he or she say, hang on, I just can't make up these stories. These numbers are just too optimistic. You just cannot do it. And if you are aware of the case of a company called Theranos, right? Inside that company there, okay, the CEO doesn't feel like there is fraud going on. Why? Because she's still getting $1 billion from the investors. The investors doesn't know that things is going on. Nobody knows what's going on. But the first person who detects that something that this is very odd is going on is the CFO. And what's the first thing she does? The CEO, what's the first thing she does? She sacks the CFO. Okay? So you don't want to go and invest in a company with the CFO is sacked 5 times within 2 years either. Something that's very weird is going on, right? Okay, so yeah, if no one wants to interview the boring guys, I think there's gonna be a lot of benefits if you want to go and interview these guys, and I'm just gonna go and grill that person to every single little details there, and at the end you collect all the information, and you go home and then you build your own narrative. Okay, don't let other people to build the narrative for you. Now, so the goal of the company is to minimize risk, maximizing profit, regarding to doing one and not without the regard of the other is not a successful one. So, for a manager to generate this much profit, the question that we can ask is, how much risk did you take in order to generate that profit? Okay, you give me $500 million per year, I thank you very much. How much risk do you take? Okay, and whether you can manage that risk. Okay, so in finance, right, we don't care about accounting profits as much. We pay attention to it, but it's not everything going into our valuation models is the net cash flows. Why? Because for us, right, accounting profits are not the same as cash flows. Profit is not cash. Profit is subject to timing of the cash flows. It can be subject to manipulation and so on. And also at the end of the day, profit doesn't reflect the risk of the cash flows. Okay, we still pay attention to profit. Profit is for us is not useless, but it's still a signal of the performance of the firm. But going into valuation models, it's always the net cash flow that counts. Okay. So how, as a manager, what do I do to maximize the value of the firm? Okay, what shareholders care about? When you invest in a share, what do you care about? Yeah, so you care about the dividends. You also care about the so the company's goals, which is reflected in the share price. Okay, so if you invest in stock, okay, two forms of return that you're gonna get. The first one is dividends, what the company pays you. Then the second one is the share price. Okay, if I want to go and sell my share price today, offload it to somebody else, how much money do I get? What's the market valuations of it? Okay, share price is the perceptions of the market valuation. How does the market view the company? Okay, I can tell you that my company was $10, but in the market it was selling for $8. It means that you think that it's $10, but the market only see it as 8. Okay, so is the market wrong, or is that you are wrong? Are you over optimistic? But this is what the market thinks. Okay, you have to go and respect that. So the goal of the company is to maximize the value of the shares. Okay, and when you maximize the value of the shares, implicitly what you are doing is that you are maximizing the size of your cash flows, the timing of your cash flow, and the riskiness of your cash flows. So I think we're going to go through valuation in the next 2 weeks, and then you see how all of these 3 things fit in together. Okay? Because valuation of something, the value of something depends on how much it is, when do you get it, and also a discount rate, the risk of it. Now, the higher the size of the cash flow, the higher the share price. Okay? Now, as an investor, I want money early. Okay? Money at a distance, I don't like it. So money that at the distance will be discounted a lot more heavily. You go through that in the next 2 minutes. In the next 2 weeks. So the timing of the cash flow, that means I want money early, and I want money with low risk. What do you mean by risk in here? Okay, risk in finance means volatility. Volatility means uncertainty. Okay, all right. So you pay me $10 of cash. He also me $10 of cash, but my cash flow has a lot of volatility. His cash flow, the volatility is lower, so I value him more. The same $10, but doesn't worth the same. Okay, his dollars is a lot less volatile compared to my dollars. It's the same dollar, but it's very high volatile. Okay, as a human, I don't like volatility. Okay. So can management really affect share price? Okay. So the value of an asset is determined by the future cash flows it's expected to generate. So management is very important because we make decisions that affect these cash flows. Okay? So managers, right, really affect the share price. Why? Because they make these decisions that altogether impact the value of the firm and therefore impact the value of the share. Okay? So you can see that it's a feedback loop that is going on. Okay, once again, we talked about the circle here, the system that has to close. Okay, as a manager, I make these decisions here. Okay, and these decisions, if I do it well, so the decisions here are capital budgeting, financing, working capital, important decisions. If I do it well, I'm gonna go and generate very high net cash flow with lower risk. Therefore, technically, I improve the value of the firm. Now, this is, the investors can see me doing that, okay? And therefore, the share price is high, okay? If the share price is high, it basically sends a feedback, okay, to the manager of the company that this manager is doing a good job. And therefore, okay, if I need to raise capital later on, I'm going to be able to do so very easily. It is a feedback loop, okay? The better job you do, the higher the share price. The higher the share price, that means you create this reputation effect, which makes life easier for you later on, which means that it's easier for you to sell products, it's easier for you to raise capital. It's a feedback loop that is going on. Okay? Now, if the loop doesn't close, you know there's something going on. Okay? And maybe you don't need to tell everyone, but at least there's an opportunity there. Okay? So, agency conflicts. Okay? Now, companies is the first time when you have a separation between ownership and control. The one who runs it is not the same as the one who owns it. What problems, what opportunities does it create? So, why do you want to become the shareholders? Sorry? You make the money works for you, okay? So the secret to get rich is to make your capital works and not your body works, okay? Means it's getting truer every single time. Most rich people these days are because they have very high quality asset, not because they earn a high salary, okay? So to make the capital work for you. But does that mean your capital is going to go and work for you for free? No. So in order to make capital work for you, what do you need to do? Take risk. Okay? So the capital is not going to work for you for free. You are taking a risk. Okay? Are you prepared to take that risk? Okay? So I invest because I want to make my capital works, and also I prepare to take risks. Just because I'm prepared to take risks does not mean that I want to run it or I am good enough to run it. Okay? So therefore, will be a manager to step in and run the company. Okay? So, okay, what about there's a conflict that's going on? So for a companies here, okay, you have, hundred thousands of shareholders. You have one manager who runs it. Now, when you have so many people, what's the first thing that you're going to have? When you have so many people, it's the first thing you're going to have. Sorry? Conflict and disagreement. That's the first thing. Okay? Disagreement. Okay? We can disagree about something. I have 10 people in my house and we fight just about what's the restaurant that we should pick for dinner. And it's a voting system that I don't know how to manage. And that's a very simple thing. And now it's a decision that involves money here. Okay? So so you have the managers, you have the companies, and then you have the shareholders. Okay, and then you also have the debt holders. Then you also have the employees, and you have the suppliers that going on. And the moment that you have a separation between ownership and management, you're gonna have so many disagreements. Okay, even within the shareholders themselves, there are disagreements amongst them. One shareholders wants you to do something like this, the next shareholders want you to do something like that. How do you keep both of them happy? Okay, and then there's a voting systems that's going on as well. How does company manage that? Okay, but let's go and simplify the problems a little bit so that we can see the picture clear. Okay, so suppose that we assume that all shareholders agreed with each other. The only disagreement that I have is between the manager and the shareholders. Okay, and this is what we call an agency conflicts. Okay, or an agency cost. Okay, so an agency relationship arises because one party called the principal hires another party called the agent, and the agent have a job to have a duty to shareholders to put the shareholders' interests above their own. Now, not all managers do, and some managers can have actions that benefit themselves instead of benefiting the shareholders. Okay, so for example, if you're the managers, you need to go to a meeting, then you're not gonna go and fly a private jet, right? The best thing for you to do is to fly economy. You see how many CEOs fly economy? None. Okay, so that's one thing. The second things is I don't know, like just I mean, if you wanna go and talk about why people have disagreements, then I can sit here and talk until the cow comes home, and we haven't even finished yet. But then there's this very common conflict these days is where the shareholders, right, want the managers to do something that's not in the best interest of the company. Can it happen? Or not? Okay, so I can think of plenty examples that the managers want to do something that benefits themselves and not benefit the shareholders. Can you think of an examples where the shareholders want the managers to do something that benefit the shareholders, but it's not in the best interest of the company? Anything? Isn't it mean that the shareholders and the companies are one? This is the same one? So benefiting the shareholders is the same as benefiting the companies. Why is that? The shareholders want you to do something that benefit them, but then not benefit the company. Can it happen? Yeah. When? Can you think of any example? Yeah, want more dividends. That's very true. And that's why the only way to increase the company shares these days is that you do it through a share buybacks. Okay, and if you just pay a lot of dividends, you have no money left inside the company to invest in future projects. Okay, so it benefits shareholders in the short run, but it hurts the company in the long run. Okay, so if a lot of you who have to go and I contribute 20% of my money in the chicken shop, he contribute 50% of his money in my chicken shops. Okay, so together we own 70%. Okay, and then every time at the shareholders meeting, we fight like hell. Okay, and he will say that I own 50%. I contribute 50%. You only contribute 20, so my voice counts more. But then I'm telling him that hey, but this is what you want is to pay a very high dividend for yourself, so that you can go for holidays, and then I don't have any money left to invest in the future long-term visions of the company. So why should I listen to you? So there's a lot of there's a lot of disagreement going on, and we had to go and look at the substance of it, compared to always assuming that one person is just wrong and then the other person is just right. Okay, but the number of ways, right? So there can be conflicts going on All right, so we don't have to wait until there are conflicts and then we go and solve it. Sometimes it's just too late. So there have to be mechanism in place so that if there are conflicts, there's somebody who is in there to solve it. The first one is to implement a very effective board of directors. Okay, so board of directors are the ones that are elected by the shareholders in the AGM, and they represent the shareholders' interest in major decisions making regarding the companies, right? Because they know that in a country like Australia, one person, one vote. Okay, if you're rich, you have one vote. You poor, you have one vote. In a company is different. One share, one vote. Okay? So if you're rich, you have higher vote. If you're poor, you have lower vote. Okay? It's just how it is. Now, so if you think about it, yeah. So that's how the system is. So who's gonna go and protect the interests of the little guys? Okay? So all you can hope for is that number one, you have very effective board. Number two is that you invest in a company that have a very large major shareholders, because he's going to look after his interest, and because he's going to look after his interest, if my interest is the same as him, then that means he's going to look after my interest too. Okay, so the classic example is Steve Jobs and Disney. Okay, so Steve Jobs was a very large shareholder of Disney when he sold Pixar to Disney, and because he had a very large portion of shares in it, he monitored the managers very closely. Okay, so he does all of the work, and I just leverage on his experience. So when you invest in a company, one of the things that you should look for is that who owns it. Okay, if the companies are owned by the majority of them are, like these funds managers, these mutual funds, right? The mutual funds do not interfere. Okay, so if you want to go and interfere the CEO, two ways that you can do it. You can vote with your voice, or you can vote with your feet. Okay, so voice means that you discipline them. Feet means you just left, and enough people left. Hopefully, the share price drop. The managers learn something, but okay. If there's someone who owns 20% stake of the company, and that is a powerful shareholder, and he has a lot of his wealth tied up in that company, he's not going to leave. Why? Because if he sells 20% stake of a company out, the share price will drop. So he cannot leave. So he has to fight. Okay? And then if somebody who is willing to do the fighting for you, then you don't need to do it. Okay, simple as that. So so one thing you can do is have a very effective board who's gonna go and fight for you, or the other person is that you have a powerful person there, because the way that company works is not one share one vote. It's not one person one vote, but one share one vote. So whoever owns the majority of the shares there has a very big voice, and hopefully he or she will be able to fight for you. The next thing is that you tie the management compensation to the firm performance. So you impose a base salary, which means that you earn a fixed salary there, and then anything that you want to earn more is going to be tied up to the company's performance. Okay, and that's very popular in practice, but it's also bad in a way that if the company's share price drops and nobody wants to do work anymore. So if you look at the employees of Facebook, okay, these employees check their share price every single day. So if the share price drops by 20%, they call up sick. They don't want to turn up to work because they felt like their salary has been cut by 25%, which is like not working as what is designed to do. Okay, yeah, you design a system so that if the share price is up, your wealth is up, so therefore you in the same boat. Okay, but a lot of these Facebook employees like, I am there because 80% of my payments comes in the forms of shares. So in terms of salary, I don't get much. So if today I wake up and the share price drops by 25%, it's like I have a pay cut of 25%. I don't want to work anymore. I probably want to go and jump to Google, where the share price has been up since last year or so. Okay, you can see that you design a system that way. Whether it works, it's another story. Okay, you also can have a labor markets and hopefully that it's a very efficient markets. That means that there is a reputation effect that the managers has to keep, and therefore if you keep on doing a bad jobs, and therefore if you get sacked, you're gonna be find a very hard time to land another job. So therefore, managers will want to do a good job as much as possible. Okay, so competitions amongst managers within the companies also provide the incentive. It's saying that if you cannot do the job, other people will take it. And last but not least is that you have a major shareholders effect. And this is there's a lot of research over this. It's called the block holder effect. Okay, there's a guy out there who owns a large block of shares, and you can see how much that person holds. Okay. There's also a takeover markets. If you are a bad company, you are a badly run company with valuable assets. So, for example, the company have very good asset, good capital, very good labor. The only person that's on the way is a bad CEO. Okay. So you become like the target of a takeover markets. There's another company that's willing to take over you to buy the good asset and then sack the managers. And managers hopefully do not want to get sacked, and therefore they'll do the proper job. Okay. And last one is the legal system that is in place to make sure that the managers do not harm the interests of the shareholders. All right. So all of these are mechanisms. Every single one of them has a benefit, also has a cost. At the end of the day, when we do things, it's a cost and benefit decision. Okay, so sometimes you don't wait until the corporate radar will take over you. Okay, because buyout is very expensive. The legal system is very expensive, and the legal system is very slow. Okay, now do you guys want to break, or you want to continue, and I let you guys go early? Break, okay? So we have about, say, 10 minutes break, and then we can just finish off. All right, guys. So let's finish off, and then I'll let you guys go. Okay? We only have about 20 minutes to go, so I'm right on time. Okay. So ethics in business. Okay. So when the words ethics come to your mind, what do you think of ethics here? Do we need ethics in business at all? So as we said earlier, right, the job of the managers is to maximize the wealth of the shareholders. Okay? So everything we do is to maximize the wealth of the shareholders by maximize the share price. So how does ethics enter the equation then? Do we need to be nice in order to be rich? Okay? Are these two mutually exclusive? Can we do both, or we have to choose? You can do both, right? Or you have to choose. You have to do both, and we can do both. And no, you don't have to do both, and it's impossible to do both. Is that true or not? Okay. All right, so and the thing is that why does ethics now come into the equation? Did we say that the system has to be closed? The money has to go and flow from one to the other, okay? And at the moment, we have a system that is closed. For hundreds of years, it's always like that. Now, all of a sudden, you bring ethics in. So how does ethics enter the equation? How does it fit into the equation here? Okay, how does it fit in the system here? Is it something that people make up, or is that because the managers have the reputation of not being not nice, and we have to go and impose the cost onto them. Otherwise, they'll continue to do the things that are not very nice. Now, look, okay. I'll try to be ESG is something that's very popular these days. Okay, you hear about ESG everywhere. So what does it really mean? Okay, E for environmental, social for has a social responsibility to the society that you live in. Okay, governance, G stands for governance, and governance means that you have an independent board of directors. This is about corporate governance. Okay, companies' management structure, transparency of executive compensation, fight against corruption. This is corporate governance stuff, right? Increase in the number of women on the board of directors and executive. So all of this sounds very nice, right? So social is accident prevention, staff training. Environmental means that it's things with the environment. Okay, so let's go and try to go and sort of see how does it fit in, and can we do both? It would be very nice to do both, because you see, right, in the society, one person, one vote. Okay, but companies have a direct influence in the society that we live in. Okay, they operate the environment, they hire people. Okay, so a lot of us will end up working in there. Okay, so they have a very big responsibility inside the societies that they live in, inside the environments that they operate. Okay, they depend on us, we depend on them. But inside the company, the voting structure is not one person, one vote. We don't count equally. Okay, one share, one vote. Okay, so the rich person counts more. So you can see that hang on, there's something that is not right. Right. So can we just make these arguments work, and how does it work? Okay. So one way to argue about this is that the money, the financial statements are the things that we can see. Okay, these are the factors that also benefit us, benefit the company in the long run that we cannot see. Okay, so for example, if you just pollute the environment, and there is great incentive to do so. Why? Because if companies pollute the environment, when they pollute the environment, that means that there is a benefit for them to do so, right? Otherwise, they wouldn't do it. Okay? If they pollute the environment, it means that there is a benefit for them to do so. But then the cost is not borne by them. It's borne by us. So there's a great incentive for anyone to do so. Would you want to go and do something that if there is a benefit, then you take it, and then if there's a cost, then everybody takes it? You would be doing that, right? Yeah? Now, in terms of the social objective, right? Companies has to maximize shareholders' wealth. And maximize shareholders' wealth means that I increase revenue and cut expense. Now, how do I cut expense? Well, the easiest expense is the employee cost. Okay? I cannot cut the environment. I cannot cut the machinery because I need them to be there in order to produce goods and services. These kind of expenses are not flexible, but the humans are. Okay, before I have 5 persons to do the job, now I can just sack 3 and saying to the 2 guys that, you know what, I just sacked 3 of your colleagues. If you want to go and keep your job, you have to go and do the work of 5. Okay, because humans are flexible. Okay, we do that. All right, so but the thing is that this is a kind of, and then on the numbers, it looks good. Because why? Your expense is lower, your revenue hopefully is unaffected. So net, you make a profit. Yeah? But it's not going to work for you for long. Okay? Why? Because, once again, capital plus labor. Okay? The labor is sustainable for a short time being, and if it's a good labor, it will leave. Okay? There's also the labor market is open. It will leave. First of all, it's unsustainable. And the thing is that the more you work, it's exceeding your capacity. You're going to have mistakes. You're going to have all of these things. Your creativity is gone. Okay? It's just in the long run, it's not going to work for you. So this is about the hidden cost. Okay? And what about the governance? Okay? If you don't have effective governance, at the end of the day, the one who pays is you. Okay? So, all right. So what are we saying is that, okay, we have to go and create a system so that if there is a benefit, okay, the companies enjoys and everybody enjoys. Why? Because better goods, better service. If the company expand, better employment opportunities. The country is getting richer. The government is happy. More people paying taxes. But if there is a cost of the company for doing so, who bears that cost? Okay. Now, if we can take the cost and give it to them. Okay, we're not taking your cost anymore. When it pollutes the environment, the cost of cleanup is you. Okay, if you want to underpay your workers, well, basically, you know, the one who pays the cost is you. Okay, that's kind of a thing. So we have to go and you know, impose some of the costs back to these companies so that at the end of the day, they see that it is in their interest to do the right thing. Okay. Otherwise, if we have a system that says if there is a benefit, they take it. If there's a cost, everybody bears. In that case, who blames them? If it's you, you will do the same. There's no incentive there. All right. So ESG works, but we have to go and make sure that and design it in such a way that it makes everybody see that it's in their best interest to do so. Okay, this is not about trying to be nice. This is about trying to be good. Good and nice is 2 different things. Okay, I try to be good to you. Right? I don't want to be nice to you. Nice means that, you know, you try very hard to be nice. But good, you don't have to try hard. You do it for your own benefit. All right. So how are we gonna go and impact this, right? So if ESG becomes like the buzzwords these days, and every time when I see that it's a buzzword, I just get very suspicious, right? Because a lot of companies can just go, you know, I spend $20 million to do this, to plant more trees, and at the same time I'll pollute the environment with a cost of $1 billion. Okay, or and as an investors, we have to be a bit smarter about this. All right. So, for example, if I see you operating a fashion, operate in the fashion industry, right? And then you were saying that you know, you have this ESG initiative, you planting a lot more trees. Now, for a fashions companies, right, the biggest thing that they do that hurts the environments is they what? fashion company probably pollutes the environment more than mining firms. What is in the form of it? The waste management. Okay, the plastic bottles comes out, the leftover things, I don't know. There's a lot of waste management. Okay, so if they saying that they doing in ESG initiatives, right? Once again, you have to watch where the money goes. If the money goes into the waste management, you know that it's good money being spent, because it means that they actually spending the money where it hurts, where the rest of us bear their cost. Okay, but if they're not spending the money on waste management because it's too expensive to do so, and they're saying that they plant more trees, then you're like, hang on, it's something that's very weird here. You can do it, and then you choose not to do it. Yeah, it doesn't make sense. Okay, or for example, there are a lot of things. So you really have to watch where the money goes. Where does it hurt? Okay, this is a cost that you are giving out to the environment. So are you in charge of that cost, or you are saying that all of us will have to take your cost? You reap the benefits, while you distract our attentions by doing something else. So, for example, if you have this management company trying to manage the arts. I mean, there's so many ethics that you can claim. You can do a lot of charity, these things, right? But at the end of the day, the key question is, how much do you pay your artists? Okay, so there's a lot of underpayment of workers in there going on. And we investors have to be smarter about this. Okay, so a lot of the fact that every company is claiming that they are doing ESG, it means it's something that's probably weird that is going on. Are they doing it to distract our attention so that we don't pay attention on the horrible things that they do, and pay attention on the little good things that they do here? Okay, so at the end of the day, everything involves a benefit and a cost. Okay, you ask yourself, okay, if it's a benefit, who takes that benefit? If it's a cost, who bears that cost? And if it's for some reason you can put the cost back to whoever has the benefit, okay, it's gonna be okay. All right, I'm not gonna go and foot your bill. Okay, so that's this seminar is all about the introduction, just to go and introduce you to the financial environment that you'll be dealing with. Now, for the next two topics, that's gonna be the time value of money and discounted cash flow valuations. So here we just gonna. So I just mentioned earlier, right? So the way to value anything in finance is not profit that enters the equation. It will be the net cash flow. Okay, so this is the first step that we build how much something worth. How much does this table worth? Okay, how much does this chair worth? How much do you worth? Now, the next questions or the next topic is risk and return, and this is where you touch a little bit of value of investment, which is my area. Okay, so I told you that my area is investment and asset pricing. So risk and return fits in there. Okay, the next 7, 8, 10, 9 seminars are looking at capital budgeting. Okay, how do we value an investment project? And last but not least is that for the 10 and 11 weeks, we look at financing decisions. Where did you get the money from? Okay, so it's pretty broad, but it's just like today, this is the master level, even though all of the concepts are still basics and foundational, but still we are open, or I'm open to discuss any of the advanced current topics. Okay. Any questions? There is a practice quiz that's going on, so you can go in there and practice as much as you like, and the actual quiz starts next week. Okay, it's all the way from week 2 until week 9. Two weeks to do the quiz. Okay, but 2 weeks to do the quiz. But I think as long as you can do it quickly, that's fine. It won't take you long, because you don't want to go and build up a lot of quizzes. things, right? So as we said, right, the purpose of the assessments is to build up your muscles. They're not for you to go and build up the AI muscle. And then, and then later on, when you have to fight, you have no muscles to fight. Okay? Any questions? Otherwise, I'll see you guys next week.